Federal Reserve voters just broke ranks, and it could break the economy. It's the first time 4 voters dissented on a single issue since October of 1992. Rate decisions move fast when this happens. Mortgage rates then follow. Here is the full pattern and the 3 moves to make before the summer rate cycle locks you out.
The Federal Reserve just cracked in public. Stephen Moran, Beth Hammock of the Cleveland Fed, Neil Kashkari of the Minneapolis Fed, Lori Logan of the Dallas Fed. 4 members of the Federal Open Market Committee dissented on a single issue at the April 2026 meeting. The last time that happened was October 1992. What happened in the 90 days after that vote is what you need to know right now, because that sequence has already started, and you have 5 Fed meetings left in 2026 to get on the right side of it. Here is what the dissent actually means. The bond market does not tune out Fed dissent. It reads internal division as a forward rate forecast. The official FOMC statement included the phrase, additional adjustments to the target range. The word that matters is additional. That word tells the bond market the next move is in the same direction as the last 3, which were 3 consecutive cuts in late 2025, meaning the Fed is still in easy mode. 3 of the 4 dissenters rejected that single word on the record. Kashkari said the forward guidance was inappropriate and that the next move should have been framed as a cut or a hike, not a cut by default. Hammock said the easing bias was no longer appropriate given the inflation outlook and that price pressures continue to be broad-based. Logan said she is increasingly concerned about inflation returning to target and that the Iran conflict raises the prospect of prolonged supply disruptions that could create further inflationary pressure. 3 voters rejected 1 word because that word was no longer true. Brent Schutte, Chief Investment Officer at Northwestern Mutual, said it plainly. In a term generally marked by consensus building and few dissents, Chair Powell concludes his tenure with 4 dissents. Here is why this matters to you right now and not at the next FOMC meeting. The last time 4 FOMC members voted against the chair on a single issue in October 1992, the Fed had just finished cutting rates from 6% down to 3% to support the economy through recession. What followed was not another cut. The bond market read the dissent as the unified rate path breaking. The 30-year fixed mortgage rate rose approximately 50 basis points within 90 days. That added $200 to the monthly payment on a $400,000 mortgage before the next meeting even convened. Then in 1994, the Fed raised rates 7 times in 12 months. The federal funds rate doubled from 3% to 6%. 30-year Treasury yields spiked 150 basis points. $1.5 trillion in bond market value was destroyed globally. Homeowners who had locked their rates before the October 92 dissent watched their neighbors absorb payment increases they had not budgeted for. The families who were stretched going in did not survive the rate shock intact. The 4-vote dissent in October 92 was the earliest institutional signal. The people who read it as signal moved. The people who read it as noise absorbed the full cost of what followed. On a $400,000 mortgage, that full cost was $72,000 added to the life of the loan. And it is actually worse this time. In 92, inflation was running at 3% and falling. The economy was healing. Today, core inflation just pointed at 3.2%, the highest since November 2023, and it is rising. In 92, there was no active war driving energy prices. Today, the Iran conflict has pushed crude oil above $96 a barrel. 3 of the 4 dissenters specifically cited the Middle East as the reason they voted no. In 1992, the inflation pressure was domestic and controllable. In 2026, it is external and driven by a war the Federal Reserve has 0 ability to influence. Right now, I want to walk you through the mechanism that connects a Fed dissent vote to your mortgage rate within weeks, how deep the 92 parallel runs and where it diverges, and the 3 moves to make before the June 17th FOMC meeting locks you on the wrong side of the rate curve. how deep the 92 parallel runs and where it diverges, and the 3 moves to make before the June 17th FOMC meeting lock you on the wrong side. The transmission has already started and the numbers confirm it. The 30-year fixed rose 23 basis points in a single week after the April 29th vote. The 30-year refinance rate hit 7.05% on May 20th, up 37 basis points in 1 week. That already happened.
Hey everyone, real quick, I gotta jump in and I gotta share something. A while back, I figured out that nobody really understands the mortgage industry. They've got to go to a mortgage broker or a bank and just believe everything they say. I put together 2 courses to not only teach you all about the mortgage industry, but how to save thousands of dollars at closing and how to save tens of thousands of dollars over the life of your loan because you know more than the average person walking in. It is an insanely low price. Look at the price down below and go, how much would I save if the ninja's right? Check it out. I don't think you're going to be bummed. Links down below. Now let's get back to the video.
Kevin Warsh, the incoming Fed chair, has been making the public case for rate cuts. But 4 current voters going on the record against the current policy stance does not resolve in a cut. It resolves in a paralyzed committee. The bond market prices the uncertainty instead of the Fed managing it. The dissent is the signal. Your rate is already moving. Here is what you are looking at across the 5 remaining FOMC meetings. The June 17th meeting is a hold. Cutting with 4 dissenters and core inflation at 3.2% would accelerate the bond market sell-off Powell is trying to avoid in his final weeks. A hold with any residual easing language pushes the 10-year yield higher within days. You will see it in your lender's rate sheet. The July 29th meeting is Warsh's first full meeting as chair. New chairs do not move on their first meeting. But if the July inflation print confirms the upward trend, Warsh walks in with the data to shift the language from neutral to cautious. The September 16th meeting is where the 92 parallel converges with the 26 reality. If core inflation is still above 3% by September, the committee faces a binary: hold indefinitely or hike. Warsh has the confirmation votes and the public positioning to hike if the data forces it. The October and December meetings are the end game. If inflation has not broken by October, the market will have already priced 1 to 2 hikes into year-end expectations. At that point, the 30-year fixed does not revisit 6.5%. It tests 7.5%. Families who positioned before June are insulated from that move. Here is what this means for where you are sitting right now. If you are holding a rate above 7% and plan to stay in your home longer than 30 months, the refinance window math works today. Divide your estimated closing costs by your monthly savings. If the answer is under 30 months, act before June 17th. If you are in a purchase transaction, the lock decision is not about where rates are going. It is about what you can absorb if you are wrong. Most lenders offer 45 to 60-day locks, and most offer a float down provision. You do not lose the lock by locking. You lose the option to lock by waiting. The homeowners who were stretched in 94 did not get to choose. Liquid reserves equal to 6 months of mortgage payments are not a savings target. That a $2,400 monthly payment, that is $14,400 that separates you from the position they were in. Stephen Moran, Beth Hammock, Neil Kashkari, and Lori Logan went on the record in April. They told you the current rate path is broken. 5 meetings remain in 2026, and each one closes the window a little further. The 92 dissent gave people roughly 90 days. The question is not whether you saw the dissent. The question is whether you are going to let 5 more FOMC meetings pass before you decide it was a signal. Economic Ninja is out.